Good morning, everyone. Monday, February 3rd. It's a beautiful day here. A lot to talk about. The headlines are probably going to continue coming in throughout this call. I think we're obviously going to talk about tariffs and our perspective on that. I think the important thing about our morning briefing this morning, which we obviously wrote over the weekend, under the impression that these 25% tariffs on our northern and southern border allies were going to be in effect. And then this morning, it seems like there might be some paring back. But the theme of our morning briefing was optimistic and bullish and kind of pointing to the resilience and strength of the U.S. economy. So that's the core theme. And I think the important part, I think lapping what was the most extreme monetary tightening cycle in 40 years in the U.S. And the consumer going pretty strong throughout, including in the fourth quarter, I think it says a lot about how strong this economy is and how much it can deal with adverse and exogenous shocks. But ahead of time, so Ed is traveling. He's heading to the Southeast as we speak. So I'll be, covering today's topical news and our morning briefing. So first off, on tariffs, I think there's a few ways to think about tariffs just by and large, like what do they do to inflationary pressures? What do they do to growth? And then how much are they, economic statecraft and a negotiating tool as opposed to a realignment of global trade? I think in the third bucket, like how much is this a negotiating tool? Over the weekend, a lot of people seem to freak out that, oh, this isn't a negotiating tool. The second Trump administration just wants to slap tariffs on anyone and everyone, and they're really gung-ho about it. This morning, that's quickly proving to be wrong, flat out, which I think it should have been evident from the first Trump administration. And I think what a lot of Trump's economic policy team has said, including Hassett, Moran, Bessent, more gradual approaches or targeting specific countries or specific commodities is probably more likely to be the outcome. So Mexican President Claudia Sheinbaum this morning spoke with President Trump in what was supposedly a long call. They reached agreements over fentanyl, weapons coming into Mexico, and also just Chinese trade being rerouted through Mexico, as well as immigration. So if you think about it, Mexico is a very strong trading partner. We get a lot of oil and everything else from them. Autos are very dependent on that. And then, of course, the labor that comes from Mexico feeds into Texas and California, feeds into construction, agriculture. So it's a very important trading partner. And the concessions reached, I think, point to the fact that this administration wanted to get on top of fentanyl and immigration. I think what was interesting, so they're pausing tariffs for at least a month. And we'll see what happens after that. They might just be paused indefinitely, and then there's no tariffs on Mexico, or more likely, probably specific minerals and products that come from China will be tariffed if they come from Mexico regardless. But Sheinbaum was saying they want kind of made in Mexico regime, theme or whatever. So kind of reshoring and onshoring their production, make Mexico great again, doesn't really have the same rhyme that MAGA does, but it seems like they're kind of taking Trump 2.0 in stride, saying this block of North American security, whether it's trade or defense, is very important in countering China. And it sounds like Trump took that to heart and he liked what he heard. And so we're not really worried that Canada and Mexico are somehow going to be our trade with them is going to be completely corrupted, and that's going to drag on global growth. However, tariffs are probably a bigger issue for growth than inflation. If you think about if you break down what is US GDP, and I'll share this chart real quick because I think it's important to consider how much of a self-sufficient economy we actually are. All right. So this chart speaks to a lot, and it's breaking down GDP. And there's a few categories left out because they net out to basically nothing. So you can see that the consumer, between goods and services purchases or personal consumption expenditures, is about 68% of GDP. Trade is about 10%, and then it's kind of this other category, which you could see, we just took it out just for readability, but it was this little residual right here, and then it basically nets out to nothing when you have inventory investment, which was an important theme for last quarter, and we'll talk about manufacturing structures, which are newsworthy and topical because the CHIPS Act really inspired a lot of semiconductor fab construction and energy projects. But it's pretty nil as a function of GDP. It's like $250 billion. It's not really anything. And yeah, so those three categories. So trade is like 10-11% of US GDP. And then if you want to lump in consumption of goods, you're getting about a third of GDP is consumption of goods or trade. Obviously, the impact is much larger. Plenty of trade is like intermediate goods that are coming to the US and then feed into our finished products. It impacts the labor market. So whether you're talking about immigration or deportations or just the cost of labor abroad, companies are often factoring in how much does it cost to make that in Mexico or Vietnam or China versus paying labor here. So it does have a lot of impact. You know, like if it's 30%, if it's 15%, if it's 50%, the feed through is pretty legitimate. I think the point that some people have made, and we tend to agree with, is that if you raise the prices on certain items, right, like lumber coming across the Canadian border jumps by 10 to 20%, there's still substitution to some degree. Consumers and producers can either shift supply chains, they can do whatever. Also, if you're spending more on lumber, you probably have left to spend or less left to spend elsewhere. So then prices in other commodities and products will fall. That's less inflationary. There are price increases that it seems like the Fed would look through. But in terms of inflationary pressures, as long as inflation expectations for businesses and consumers don't rise dramatically, given the fact that they've remained pretty contained after the latest like 40-50% cumulative rise in prices over just a few years, it seems like that would get looked through, and demand isn't spurred by an increase in fiscal spending or like dramatically easier monetary policy. You don't really get an inflationary pressure, but you do get less income to spend. So I think tariffs are more of a tax, and you're reducing producers and consumer spending power. How much of that is offset by a lower corporate tax rate and deregulation? Maybe all of it, maybe some of it, maybe more than all of it. So I think that's part of our 20% what could go wrong bucket, right? That these tariffs are spread throughout our global trading partners. They actually do weigh on demand because critical inputs are costlier and people have less after-tax income to spend. It's a what could go wrong bucket, and it's not weighing on our roaring 2020s probability because we're still quite bullish on deregulation and a lower corporate tax rate. We're still very bullish on AI, automation, robotics, and we think the S&P 500 and the U.S. economy can kind of lap these pressures. If I don't think anyone really thinks our trade or anyone's trade with China is fair and balanced. I think Mexico and tariffs on Mexico and Canada kind of ruffled the feathers a little bit because those are very close trading partners and definitely not adversaries. But if we're kind of making sure that China isn't going through a third party of Mexico and maybe that'll be Vietnam and whoever else later on, and making sure that fentanyl and immigration are we have a partner, I guess, in controlling that, then I think it kind of makes sense. So overall, let me stop sharing real quick. Overall, I think the theme is roaring 2020s are intact. Tariffs are going to be a combination of economic statecraft and negotiating, raising revenues to offset the loss from a lower corporate tax rate and the extension of the TCJA. And, we'll see. I think everything's very fluid. The first 100 days are going to have a lot of headlines. Ultimately, things went, the S&P 500 took a little bit of a hit in 2018 and 2019. Tightening from the Federal Reserve played a role there, but there really wasn't a big inflationary increase. And there's a pretty, we've been talking a lot about kind of goods deflation and import prices in the US, and therefore goods CPI and the PCED have been falling, deflating for like at least over a year, if not a year and a half. And much of that is because China depends on the US consumer to buy their products and US producers to buy their intermediate goods. And really no one sells anything to China unless you're selling them commodities. Like the trade is quite unfair. You're mostly buying from them. That's China's kind of MO right now, is to export its way out of this recession. We think it's a bad idea. It's not really how you shore up an over leveraged, property bust economy, but that's what they're doing. So I think they depend on the US consumer to continue purchasing their items, and they depend on the EU consumer, but the Eurozone is in much more, dire straits than we are. Growth is slowing. It's in contraction in Germany. Germany's in a recession. So I'm not sure that this creates a huge boost in goods prices. It's, services inflation is what's sticky in the US and kind of an issue. And sure, there's a feed through, but we'll see. I think the bigger risk is growth, but it's more so that that's a tail risk, not that it's a high probability one. It's just a tail risk that can be pretty extreme in terms of its outcomes. So that's tariffs. I also implore you guys to, ask questions throughout, and I'll just hit them. There's a lot going on, so I'll just take them throughout and kind of give you our perspective, and what Ed and I and the rest of our team are thinking. But in the meantime, I'm going to go ahead and talk about fourth quarter growth and kind of the setup, and also ISM this morning, which was an important part, I think, of this overall story. Where this chart may be. Sure. So ISM this morning, finally back in expansion, 50.9 for the manufacturing PMI. It's been kind of coming for a couple months. If you slice and dice the New York Fed and other regional Fed manufacturing PMIs for their specific regions, it pointed to an expansion. New orders jumped, employment jumped. Employment was back in expansion, importantly, and things looked pretty good. And if you look at some of the comments, some of them were saying supply chains for critical minerals are a little tight. Others were saying Chinese stimulus is helping us. And mostly that, we're waiting and watching for tariffs, but, supply chains are mostly in better shape than they were pre-COVID. So I think that firms can, whether tariffs erode profit margins, whether they hurt foreign producers or they get passed on to US consumers, I actually think that supply chains are in a pretty good spot to handle that rerouting, and it won't necessarily erode margins or get passed on to consumers as much as it might otherwise. But let's go through. So Q4 GDP was, it rose 2.3% quarter over quarter. Pretty much all of that reduction from the 3.1% in the prior quarter was due to inventories. We actually think this wasn't like front-running tariffs or something. I mean, people were drawing down on inventories. And I can show you a chart later, but we think it was mostly a lot of auto sales without rebuilding of auto inventories. They had kind of been building up, and then like domestic truck inventories fell by over 25% in the fourth quarter, and sales were quite strong as well. You get like that year-end sales effect. So we're not worried about it. I mean, personal consumption expenditures were up 4.2%, incredibly strong. And then core GDP, the private domestic final sale or final sales to private domestic purchasers. It's a little bit of a tongue twister, which is our kind of core GDP. It's what the Fed likes to look at, was up 3.1%. So again, very strong. And I want to talk about durable goods real quick, but let me just take a look at the Q. Okay, yeah, I'll hit this really quick. So yeah, I tweeted earlier about kind of the yield curve flattening and the 10-year falling. So the immediate reaction to tariffs from the weekend and coming into today was 10-year real rates or tips were down about 10 basis points. The yield was down about 10 basis points to about 2.05%. The yield curve flattened about 5 bips. And then the shorter end was basically flat, up a tiny bit. I think what the market was reading is, okay, tariffs and potential inflationary pressures, might keep the Fed, staying pat for now. That probably boosts, if it boosts goods inflation at all, then 3.5% super core CPI is pretty much all services. So if it boosts goods at all, then you start getting a 3 handle on inflation, which the Fed can't cut, and ostensibly there's some odds of a hike that get priced into the futures market. So I think that makes sense. This has all kind of come off a little after after what Mexican President Sheinbaum said, and Trump's call with her, and then we'll see what, supposedly there's a call with Trudeau at 3 p.m. today. I don't think us or Canada are as optimistic that, it'll achieve concessions or some sort of win. There's also domestic issues in Canada where Trudeau is kind of on the way out. So we'll see. But yeah, I mean, I think we're at 4.5% on the 10-year. Again, it makes sense. It's kind of our story. We could easily see a yield curve around 30, 50 basis points in terms of steepness, which was kind of the late 1990s yield curve. So I think that initial reaction makes sense. But again, rates volatility has been incredibly high and much higher than equity market volatility. So it's kind of tough to read those on a day-by-day basis. And hopefully that answers the last question as well. Really quick, I'm going to hit on goods because I think it's an important point and ties into ISM, and then I'll take a couple more questions. So goods consumption soared in the fourth quarter, and no, it was not due to front-running tariffs. If there was some residual of front-running tariffs, then sure, but I really don't believe so, and we don't think so either. So real PCE for goods, so inflation adjusted, was up 6.6% quarter over quarter, and then a seasonally adjusted annual rate. Durable goods were up 12.1%. That's substantial, and no, we don't think it's front-running. If you look at the previous few quarters, durable goods consumption was negative in Q1, and then up like 5%, and then up 7% and change in Q3. So it had been accelerating. I mean, if you think about like the goods cycle, right? We pulled forward all the 2022 and 2023 demand into 2020 and 2021. We had stay-at-home orders, we were flush with cash, and no services to spend on. So goods were depleted by that. Goods were depleted by higher interest rates. If you bought a washer dryer in 2020, you didn't need one 2 years later. And if you financed a car purchase in 2021, you definitely didn't want to do it in 2023 when the rate on your loan was substantially higher. Home sales also slowed as mortgage rates rose, so you didn't get all the accompanying goods demand after that. We think that's kind of over, or at least consumers have exhausted their exhaustion, right? People are now spending on goods. I think that'll continue. I think people's real incomes have been rising, and this is probably a story that helps with tariffs too, right? As long as your real incomes are rising, you're good, right? You can kind of handle those price increases, and your real wages are increasing, and you're better off financially. So as goods demand in the US picks up and higher for longer, or in our view, normal for longer interest rates kind of set in and consumers get used to them, I think this continues. Services are unique in the fact that you can continue spending on them. You can go to a concert every other weekend if you want to. So that type of spending is just continues and continues and continues. But I think as people buy homes, as people start to refinance and pay down their mortgages, which we're already starting to see, despite the fact that mortgage rates are still like 7% because people have life events, as people return to work or RTO, going back to the office, I think this stays. And I think it really points to the fact that consumer spending is and will continue to be strong, and that people's demand for things is about more than just small relative price increases. Oh, and also, this is kind of a question mark. Real consumption of goods has really benefited from deflation because you're getting a boost from inflation adjusting it. Sure, real consumption will fall a little bit as goods inflation kind of comes back. I mean, we're going to get base effects anyway. The question is, how much does higher prices weigh on demand? And as of right now, we're pretty optimistic it won't have a really meaningful impact. Okay, I'm gonna take a few more questions. So from Michael Brush, in 1929, exports were just 5% of GDP, yet Smoot-Hawley supposedly contributed significantly to the depression. How is the exports are a low percentage of GDP any different now? It's a good point. I think the agricultural sector had such an outsized impact. So it's like, what, 100 years ago now? They were a huge part of employment and a huge part of the overall economy. So I actually think I thought exports were a little bigger than that as a percentage. But regardless, they were much more intertwined with the rest of the economy. So if you kind of crush a goods exporting economy and you kind of prevent that, we were exporting so many soft ags, then it feeds through very quickly. And access to credit was also a huge player there, right? Like farms couldn't access credit from their banks, and then that kind of led to a whole credit crunch and led the whole, credit cycle theory or whatever. Right now, and the Q1 senior loan officer survey comes out today. But right now, lending conditions are easing or should be easing. Loan spreads aren't rising, they're falling. Getting even rid of the private credit market, right? Like banks are ready to lend. So access to credit is pretty good, I think. And if anything, getting better. So that kind of prevents that whole depression spiral. But again, could be wrong, right? Like it's in that what could go wrong bucket. I think this morning's negotiations or whatever you want to say point to tariffs will still be used on adversaries. Tariffs are meant to reshore domestic manufacturing, and the part of the outcome, the end result, will be a stronger Western bloc and more energy security in North America, but also Europe, and more defense security, and just like less reliance on organizations like the WTO and obviously NAFTA is a trade agreement, and NATO in Europe, and more on kind of like a reconfiguring, probably where the US has more power, but a reconfiguring and strengthening of those bonds. But good question. Eric, given the present condition of the Chinese economy, what exactly could they do to help balance the trade deficit between them and the US? I think they have to boost consumption. They have to do direct fiscal stimulus. It seems like what they're doing is starting to work. They're throwing like kitchen sink monetary policies and then some like measly fiscal policies into the market. I think part of it is because some of the debt in these local government financing vehicles and in local governments is like really toxic debt. They're super over leveraged, whether it's like 300 or 350% of the GDP there. And the loans were all made for bunk projects, right? There's no ROI. So you have to deleverage all of that. And the question is how much, like, how do you deleverage it? Well, you do fiscal stimulus and you give people money to spend. There's probably some cultural differences. Like an autocratic regime is not going to feel good about transferring wealth lower. And the lower to middle classes of China have done so well for the past 40 years because the whole country did well. But their share of that overall wealth was declining. It's just that like, even if you went from 30% of it to 20% of it and it grew like 5 times, you still, had more income afterwards. So I don't know. I don't know if China has figured it out, but I do think that their stimulus is starting to take hold, and that actually should keep goods prices somewhat contained, or goods inflation somewhat contained, because they're boosting production and capacity at the same time that it's already over capacity, so to speak. Okay, let's talk a little bit more. I'm going to shift back to the charts and the morning briefing, but please keep the questions coming. So this is, I think, going to become a bigger story for this year and next year, and it is the higher wage or higher income workers in the US. So immediately after the pandemic, really high inflation, especially for like the bottom tier of Maslow's, pyramid or hierarchy of needs, got crushed in terms of inflation. So lower income households especially were really losing out, but very quickly, or at least over the next year or two, wage gains for lower income workers shot up. Like there was a huge shortage of workers. There's a really big retirement wave for baby boomers. And so nominal wage increases started to beat inflation. And that was really good. And so for the last 2 years, we've seen real wage gains for lower income workers who are 80% of the employment base. So it's very important. What you can see here, though, is that high wage workers, so they're only 20% of the workforce, but they're a meaningful part of the tax base and of spending, were losing out. Their nominal wages weren't rising. It wasn't a really strong market for white collar jobs, and inflation was taking out, their real wage gains. That's starting to end, and their real wage gains are starting to accelerate quite quickly. So you can see the uptick over here. And some of that is catch up to the past couple of years, but I think also it's some of the public sector catch up because their wage gains kind of lag. I think given kind of like how important this group of people is to consumer spending, that this could easily keep, goods demand and goods PCE higher for the next year or two, even if like there are some wage pressures or like there's some issues from tariffs. I think this spending will continue. And these people still were spending for the past couple of years because their non-labor income was more than supplementing any real wage losses. If you look at, this is all non-labor income stuff you get as like a landlord, everything you get from interest, money market funds, which are predominantly higher income people, dividends, that's like over $7 trillion in income as it stands. And then there's the whole wealth effect from higher stock prices and higher home prices. Of course, these people own more homes or have bigger, more expensive homes. So those have helped higher income workers thus far, but I think now it's real wage gains that should be powering their spending and preventing some sort of kind of, retrenchment and rebuilding of savings. And the savings rate is quite low. We're not worried about it. It was much lower for a bit before there were revisions to real incomes and real spending. But I mean, baby boomers who are retired have a ton of net wealth or net worth and minimal, if no, wage gains. So it's all non-labor income. And then the wealth effect, the savings rate could easily fall towards zero, throughout the end of the decade as it's, mostly the wealth effect kind of powering spending. And I mean, it might actually be the wealth effect and then average hourly earnings increases because the kind of dual impact of less immigration and or negative immigration on a net basis because of deportations, as well as AI and automation, is you probably don't get any increase in average weekly hours. And the labor force probably stops growing or not growing as rapidly. We're going to get a huge boost in the January and February data because the Census Bureau found another 3 million immigrants over the past 2 years. So that'll all get incorporated. But that labor force growth is no longer going to be a huge contributor to GDP for at least the next few years. So aggregate weekly hours, which is, just taking how many hours are you working per week plus the growth in the labor force, we find is pretty correlated with GDP and the coincident economic indicators, the CEI. It's probably going to fall, or not grow as quickly. So where you're going to get most of that growth is going to be from real wage increases, non-labor income, and the wealth effect. So we're still optimistic. We think productivity is going to bring, higher real wages. We'll get Q1 productivity on Thursday or sometime later this week, but that'll be the core drivers going forward. All right, I'll take a couple more questions. Yolanda, what is your view of what Trump would like to see from Canada and Mexico in the near and long term? Yeah, so I think the 51st state stuff is kind of a mirage and to kind of like poke at Canada a bit. It seems like immigration and fentanyl are quite important. Overall, I still think China is a focus, right? China was a focus in Trump 1.0. I think it's a focus now. It was a focus of the Biden administration. It's incredibly important. And like, I don't think DeepSeek is the reason, but it kind of speaks to the fact that we're competing with China. And they also have a lot of critical minerals. So, and, like Taiwan, which is a big chips maker, is quite close to China, if not like within China to some degree. So I think that is still the key issue. And I think the Trump administration is upset or not happy about the amount of goods that are surpassing tariffs, which like the Biden administration increased tariffs on China, are not thrilled about the amount that's coming through, and then immigration, and then fentanyl. So I think the goal is to fix those issues and also secure energy security. Like energy was one of Besant's core tenants. It's one of Trump's core tenants. They think it's going to bring down prices. You don't tariff Canadian oil by 10% if you want lower oil prices like on the surface. I think the goal is to create a more like contained and secure block so that energy in North America is less sensitive to OPEC plus, which includes Russia and just like global energy flows. I think it's possible given the U.S. and Canada either are at or above OPEC plus production or exports in terms of energy. And Mexico is a big producer as well. It's our second largest importer. We import the second most energy from Mexico after Canada. Granted, Canada is much larger. But yeah, I think we'll see. But I think those are the key issues. And I think Canada is just in a weaker economic spot than they have been relative to their own history and relative to the US, where maybe they can push Canada harder because they're on more thin ice, I suppose. Okay, I'll take one more question. We're kind of out on the charts and we're out of time. So this is one from Paul. So are those being deported actually contributing to the economy? In other words, do they have jobs? Yeah, they contribute in a pretty meaningful way. It was why when that first benchmark payrolls revision came out last year, we kind of shrugged it off, thinking that it missed a lot of immigrants who have a very high labor force participation rate. Much of them are within the working age population, and they come here for jobs. Like that's overall, right? It's like millions and millions of people. So yeah, the agricultural sector and construction sectors are big employers of immigrants and to some degree need immigration. I think we had such a huge wave, and I think the workers that have already come here over the past few years will become more productive or get older, gain more skills. So I think like if you had an incredible above trend amount of immigration, you had an incredible above trend amount of retirements, and then both of those level off pretty meaningfully, you still have that big increase in the chart that you're still going to kind of work through. So I don't think it's a huge deal in terms of, you know, like a nominal wage pressure that feeds into overall inflation. I don't think it's a huge issue outside of specific companies or like areas for overall employment. I think there's some slack in the lower income cohorts, like younger workers, less than a high school degree, border states. There's a little bit of slack there. That's where the unemployment rate was starting to rise. So, you know, it's important, but I don't think it's like cataclysmic to the economy. We'll see. I think deportations might scare some of these workers and employers for the next couple of months. So we'll see if that feeds into payrolls at all. But overarchingly, I don't think it's like you know, economy ending. Okay, that was a lot. I appreciate all your questions. We will obviously keep you updated via briefings. Our briefing tomorrow morning will have a lot more on Canada and Mexico tariffs and quick takes along the way. But thank you all for joining and have a great week.